The World Bank and International Monetary Fund spring meetings have come to an end, and a lot has been discussed. And top on the agenda, concerns over high inflation, rising geopolitical tension, and financial stability. Joining me now is Yabo Masha, Head of Secretariat and Director, G24 Washington, joining me via Zoom. Great to have you on the show.
Yes, good morning and happy to be here.
Good morning. So the meeting has finally come to an end. What were the key takeaways for you?
I think the way to look at it is that the world is going to be in a period of extended crisis, economic crisis. The projection for global growth is one of the lowest in recent times, and inflation is expected to remain high at around 7% even into next year. So what that tells me is that advanced economies are going to continue the kind of policies that they need to undertake in order to rein inflation. And once they undertake those kind of policies, like increasing interest rates and monetary tightening, then what it means for developing countries is that their economic circumstance is going to worsen. Higher debt vulnerabilities, fiscal and current account imbalances, and maybe some instability in their financial sector. So on the whole, I think it doesn't look that good, but anything could happen to change the direction that we're seeing now.
Quite a number of bleak forecasts we got from the meetings, especially for poor countries. But what do you think, poor countries can do at this time to create some kind of buffer?
So at this time, what is more important is multilateral coordination and cooperation. Most poor countries have exhausted their domestic buffers. So the idea that they can do certain things to improve on their outcome on their own is really something that has to be weighed in balance. I think that for the international financial organizations, the IMF, the World Bank, they're trying to at least play the role of, in the case of the IMF, the lender of last resort. So a lot of countries can, explore opportunities for financing so that they can have the liquidity to at least continue to operate their systems. They can, of course, approach their creditors on improving the terms of their debts and their loans to them. And at the same time, they need to make the kind of macroeconomic adjustment that will make the transition more orderly. There has to be a balance. Countries cannot engage in 100% austerity measures because then there will be no growth. And at the same time, they cannot implement 100% accommodative policies. So what they're going to do is to find a middle ground where they can at least continue to meet some of the obligations, the most important obligations, and at the same time explore opportunities from the external global environment.
And recently, the Nigerian economy was described as stable, and some Nigerians have been questioning this perspective. As the most stable economy on the African continent, we've seen FX challenges, mounting debt, inflation, reducing manufacturers' confidence, negative PMI. How do we define stable here?
Well, I think one way to put it into context is to look at what has happened, how the economy was growing in the past. So if an economy grew at around 7 to 8% annually, and it's now growing at around 3%, 3.2, 3.3, well, it is still doing better than an economy that has negative growth rate. So that, I think, is context that you have to put into that issue. There's still a lot of activities going on in the country. It's just not sufficient to have that generalized increase in growth or increase in economic activities. But to the extent that a country is able to meet its obligations, especially to creditors, then the convention is to classify that country as stable.
And debt is definitely a big issue now for poorer countries in the world. And the IMF's decision to raise the annual cumulative limits of access for borrowings under the General Resources Account is supposed to help countries facing increased financing pressures. How exactly is this going to help?
The General Resources Account, many of the African countries do not qualify for that account. This is the facilities in this account are more for middle income and high income countries. Now, most of the ones that IMF raised recently that raised the access are mainly a lot of the precautionary facilities, the kind of facilities that countries can approach the IMF at short notice and apply for these kind of facilities without any extended period of negotiation. So if a country is becoming liquidity constrained because it cannot generate enough balance of payment in its balance of payment to be able to meet its obligation, and its creditors are not extending to it the lines of credit that it needs externally, then such a country could apply for the general resources account, which is now around 200% higher what it can apply for. It's a bit like an overdraft, a banking overdraft, because then you have the liquidity to meet your obligations and to continue the adjustment process.
And the Global Sovereign Debt Roundtable met to discuss debt sustainability and debt restructuring challenges and ways to address them. What were the key highlights for you in that discussion?
I think what we have seen in the Global Sovereign Debt Roundtable is that there's only one test case, and that is Sri Lanka. Sri Lanka has an understanding with its creditors in which some of the creditors have decided to defer its debt service for 2 years. Some have extended the maturity. So all of that come together brings Sri Lanka's debt to a level that it can manage, that it can continue meeting its obligation. And on the basis of that, Sri Lanka now is able to qualify for an IMF facility, which was approved last month. Now, the point is that for us to be able to see how it's going to work very well, then we need to see this particular agreement work out for about 3 months. So the challenge is that other countries, like the low-income countries, they are under a different set of framework, which is the G20 Common Framework. And under that framework, no country has been able to have debt resolution because of the inability of the creditors, both the bilateral and the private creditors, to agree on the way forward for these countries. Ghana appears to be moving in the right direction, but we need to see what can come out over the next few weeks. The challenge with many of the developing countries is that it's not only the external creditors that they need to reach agreement with. Many of the low-income countries have substantial domestic debt owed to their banking system, the private sector, the pensions, all manners of debtors, all manners of creditors, and that becomes more difficult. One of the things we've seen in the case of Ghana is that in order for Ghana to be able to progress within the debt resolution framework, there has to be a write-down of around 30 to 40% of the creditor's stake haircut. So if you're having a haircut of around 30 to 40%, and the external creditors have the capability to cope with that, but domestic creditors, you're essentially cutting off the assets of the holders of those instruments by 30 to 40% of its face value. So those are the challenges we see going forward. The test case, both Ghana and Zambia, if they're able to resolve successfully, then we could look at the areas in which we can improve the framework and we can get more countries to be able to take advantage of that.
And most of these countries, the debt burden is so high at this point, and we've seen, people accuse some of these governments of not using, most of the debts they've accumulated. They've not used it judiciously to develop the economy, but they still go ahead and borrow. Is it right to still, give such countries, more loans, knowing that they're still struggling with debt?
Well, I mean, there has to be a balance. Without any financing, absolutely zero financing, such a country would go underwater, as it were. So countries need external resources to be able to finance their balance of payments, their current account in particular. So imagine a situation where there is no access to liquidity and a country cannot import, cannot do anything, then that is worse than, just conducting the kind of measures that means absolutely zero debt. I think the fine balance is for countries to, first of all, at a time like this, prioritize what they want to do, what they should be doing with them resources. And then the second issue, of course, is that if they get additional resources, then they should at least have the projects to show for it. Of course, not everything is project. Some money is spent on programs and people don't see programs and they assume that their leaders are not making the right decisions. But all in all, I mean, it's a joint responsibility. It's up to the civil society and the citizens of countries to take their governments to account and have some discussions on how the resources are being spent.
But at that global sovereign debt roundtable, the meeting referred to fairness of debt restructuring processes. What would fair look like?
The issue of fairness is really something that is used to describe the outcome for different creditor classes. So you have private creditors, like a lot of the private market bonds that countries contracted. Those are private creditors. And then you have the official debt to multilateral and regional development banks. And of course, bilateral debt is there. Maybe they owe some debt to China or to their other India, other major trading partners. What they are referring to as fairness in this case is that the outcome, the resolution, should provide the same kind of outcome for these creditors. So in the sense that if domestic creditors are going to take 30% write down, for example, the external creditors should not be in a position where they have to take 40 or 50% write down. So that in essence is what the issue of fairness is about. But it also has to be fair to the country, fair in the sense that if the country, whatever the agreed framework at the end of the day has to be set in such a way that whilst the country is able to.
And definitely, we know that debt is looking more risky at this point, with countries not able to, give us some of these loans. But we know the IMF noted that developing countries, including Egypt, have to reduce energy subsidies as the quickest way to achieve savings. In Nigeria's case, a total removal is scheduled for June. What would you say is the best way to handle this, because of the consequences?
As far as I can tell, the Ministry of Finance is handling the issue very well. They have put together some of the programs to support the removal of subsidies. And what I'm hearing is what some of the things we have seen include making some facilities available to low-income people, supporting people's income, and deployment of whatever palliatives they have in mind. So that's as much as can be done. I don't see that under the circumstance, there's much more that can be done. It's like taking a bitter medicine. It's bitter, it won't taste good, but it will cure the disease. So that's the way to look at it.
IMF's latest fiscal monitor titled On the Path to Policy Normalization. Nigeria is asked to increase tax net, but that is not the news we're getting at this time. Some believe they're saying that we should raise taxes, and we already have some people actually against raising taxes at this time. What do you think?
Maybe there's a kind of a misinterpretation of that recommendation. The increasing the tax net is not the same as increasing the tax rate. When you look at the numbers from Nigeria, if we look at the corporate income tax category, for example, the statutory rate is 30%. And in many countries, it will hover around be anywhere from 25 to 35%. Now, that is a statutory rate, but when you look at what is actually being collected and you kind of come up with how much that means, what percentage that means, it's actually around 4%. So in other words, there's around 26% that is not being collected. So when recommendations are given about tax collection, it is about a country improving its tax collection framework so that it can collect more taxes than it is. That has to do mainly with the efficiency of the system. How efficient is the system in collecting what is due? Collecting what is due obviously involves fighting illicit financial flows, which is draining a lot of resources out of the country, and combating aggressive tax avoidance and evasion. So if these are addressed, then there's no need to raise the tax rate in any way because there's enough activities going on and there's enough that can be collected without increasing the tax rate. The problem with increasing the tax rate is that it only penalizes the small percentage of those that meet their tax obligations because they would then even have to pay a higher tax rate. Some of the reforms, I think last week, Nigeria announced that it has now accepted to participate in the OECD framework, which is for global corporations, and now that framework fixes a 15% minimum tax that countries would collect from, or at least that the corporations will pay the countries. Now, that is about half of the statutory rate of 30%, but when you take into consideration the fact that Nigeria is only collecting about 4% anyway, so if we're able to collect 15%, then we're talking of more than 300% increase in the tax that will be collected, which would really make a lot of difference and allow government to be able to push more money into the economy and get the economy rolling.
All right, but before I let you go, just a quick one. I want you to just look into your crystal ball. We have a new government coming in next month. Tell me, what do you see for Nigeria's economy going forward?
Well, the fundamentals of the country are still good. The country has a very high potential, a lot of unexplored areas that a new government that has the focus and that will put together a credible economic program will be very, very successful. Indeed, some of the challenges of the country are in two broad areas. That's in the policy framework, the policy design, and the second area is the way these policies are being implemented. Assuming that government is able to focus on this strongly, then there are many options on the table for the government to be able to re-engineer the economy and put it on a very strong growth trajectory.
Right.
But there are some short-run macroeconomic challenges that government has to face, and that is how to make its debt more affordable. And affordability, we're talking of really the issue of how much it has to service the debt. That is addressed once this reform of the tax framework is undertaken. So in summary, I would say that one is to have the policies and programs, which is a strategic focus, and then to have the implementation capacity, that is more of a tactical issue, and to have the leadership to implement all those very necessary reforms.
All right, thank you so much. I guess we'll leave it there now. Talking to Mrs. Iyabo Masha, Head of Secretariat and Director G24 Washington. Thank you so much for your perspective today.
Thank you.
All right, so after the break, we'll drill down on Nigeria's inflation numbers for March 2023. That's our next conversation. Just stay with us.